Welcome to this month's Agent Advantage. Our mortgage detectives are back on the case, answering the mortgage questions agents don't always think to ask but should. From overlooked loan programs to common misconceptions, we're uncovering insights that can help you better educate your clients, strengthen your offers, and stay ahead in today's market. Together, we can crack the case. If you want to skip ahead to a specific question, check out the timestamps in the video description. Let's get started.
The basics in doing this are very simple. Always make more than the minimum payment. Always pay early or on time. You can also, depending on the creditor, make multiple payments. A lot of times they will report extra payment and pay early. This benefits your credit score as well. When you do run a credit card balance, paying that balance down to less than 30% of what you put on it is crucial, if not paid in full. There are more emphasis now in seeing full payments each month and a greater effect to your credit score balances.
Do you have clients that are concerned about their credit score, think that there's no way they could ever possibly buy a house because somebody told them that their credit score was too low? This is where we step right in and give you the answers that you need, because we have an in-house credit specialist who is amazing. But really, he comes in and looks at the people's scores and looks at the three big factors. Did they pay on time? Is their credit value under 30% or less of what is totally available to them? And don't close old accounts. People think, oh, I'm going to get rid of things that are there from the past and then they won't show up anymore. But those seasoned accounts really held value. Want to know more about it? Let us know. We have CE courses and options where we can share that information with agents and with clients to get them where they want to be ready to buy a home.
Mike McNamara is an awesome presenter when he does his CE courses for credit. He's very engaging. Last one we actually had, there was a lady that had been there, I think it was her 6th or 7th time attending, which I think that speaks volume to show that it's a great class. And it is 4 hours in North Carolina, so it does take some time, but you knock out your 4-hour elective, and he does a really good job and very informative, but still keeping it engaging.
So I am not a fan of people that are sitting on the fence because they're either in a house that they don't like or they're currently renting. So if someone is interested in buying, I always advocate get pre-approved, get with a lender, because when rates drop, that means that prices are more than likely going to increase. When the rates are lower, there's more qualified buyers. You can always refinance a rate, but you can never refinance a sales price.
My answer 100% across the board is usually going to be a bridge loan. The reason being, a lot of bridge loans out there right now offer the removal of that liability of the existing home, and you're able to make a non-contingent offer that allows you to make a much stronger offer, and you're not worrying about having to pay 2 mortgages because most of them will pay that mortgage payment on the exiting property during that time frame. So a bridge isn't going to add to your debt to income ratio where a HELOC will. Also, a HELOC really only works if there's enough supporting income and at the same time there's enough equity. So it's a very situational fix versus the bridge seems to be able to cover a larger percentage in helping that client achieve that close.
So if a client doesn't have standard income, or maybe they're self-employed, but they write off a bunch of stuff on tax returns, there's all kinds of different programs like bank statement loans, DSCR loans for investors where there's no income documentation whatsoever. But there's a lot of different options. And once they talk to the lender and we figure out which option is going to be best for them, we can help guide them through. And maybe it is a bank statement loan versus using traditional tax returns to qualify.
I'll use an example that I just got off the phone with the client. He's been in golf cart sales for the last 3 or 4 years, and then as a W-2 employee, and he's just now gone over to self-employment. You know, most lending guidelines require a 2-year work history. Well, this unique transformation going to self-employment, we're able to actually close that loan once we have 12 months business bank statements utilizing a non-QM loan. Non-QM business bank statement loans go off of 12 months history. And as long as you have a 2-year history in that field, this one being sales, you're able to move forward and close those loans ahead of your client having to wait 2 years. You also are allowing that client to utilize the U.S. tax code to their greatest advantage, writing off everything they need, because we're going to look at an income based on deposits, not based on tax returns.
Ever wonder how an appraiser lands on their value? They just pick it out of thin air, maybe? No, that's not how it works. And it's not what we do either. It's not the borrower, it's not the lender, it's not me, it's not you. We choose a third-party appraiser. Someone we don't know. We don't know what they're doing or how they're doing it. They go out, they look at the comparables, they look at the size, they look at the property. They have a set checklist and come through with a number. It's not guesswork. It's science and it's real, but we let them do the work and then we share that information with you.
When an appraiser goes out to a property, they will pull the most recent comparable sales for that property within a couple mile radius. They want to find that the house has been similar in size, condition, and shape, so that they will base it based off of those previous sale prices.
If a client thinks that they don't qualify for a home because of down payment, that's a common misconception. There's a ton of down payment assistance programs. There's some through the state. In North Carolina, NC Housing is a great option. We've also got 100% financing on FHA. That one has no income limits. You don't have to be a first-time home buyer. You just got to qualify for the program and meet the FHA guidelines. So a lot of people think they need 20%. It's crazy. You still hear that. I actually saw a study recently through, I think, Zillow that said like over 50% of people that they asked thought they needed 20% down. It's definitely not the case. So just making sure that the client's educated of the down payment assistance programs out there and grants. We have grant funds that occasionally come out. Those are more time sensitive. They come out typically in the beginning of the year, but the state programs and the FHA product at 100% financing, 0 down, are available year round.
Well, we offer a lot of different grants and other home buying pieces that will allow a buyer or a potential buyer to realize their full potential. Whenever we want to chat with those folks, we always want to have a full understanding of where they're at, what they do for work. That is going to help us reach out to all of the different down payment assistance or other products that we have availability to that will help them come up with whatever they need and then get them some numbers that will hopefully get them into a house.
There are so many options out there, and our team is literally the #1 team when it comes to working with Virginia housing and first-time home buyer options. But we also work with all the different grants, city grants, state grants, federal grants. And what people don't know is sometimes those can actually get stacked, so you can use more than one. There are ways to do this. 100% financing options, grant options, that you can come in and find out what your buying power is, because it may be way more than you think.
All they're doing is thinking they don't qualify. They haven't been pre-approved yet. So the first step is them getting with us. We can meet with them face to face, go over all our grant programs that we have. We have 100% financing options. There's tons of different solutions where we can find a route to help them. Also, if they're not ready at that time, we can put together a game plan, so it's not just something they're thinking and hoping for. It's something where we're creating a game plan for them to buy in the future.
DSCR stands for Debt Service Coverage Ratio. Simply, does the revenue cover the mortgage? Is the best way to look at that. DSCRs are non-QM loans, but they are great investment loans that offer higher seller concession limitation. So in a lot of instances, you're able to buy an investment property, you're able to close it into an LLC, unlike a conventional loan. And if you utilize it correctly and utilize the seller concessions to your max benefit, you can buy the investment property by bringing nothing but the down payment to the table. So you can come out of pocket the least with the lowest monthly payment and close it into an LLC, separating your liability on investment. To very quickly answer that, I would say there's a handful of reasons, but the most important is they understand the market and the property type in which you're buying. For example, in Horry County, there's a lot of condotels. So dealing with a lender out of state that doesn't know what a condotel is causes a lot of issues. Using someone that knows it, knows the market, knows how the state taxes, knows all the ins and outs, including tax exemptions that you can apply for, is part of what you're getting. The other part of it is customer service, but a local lender is the only one that's going to be able to deliver that over some nationwide person that doesn't know what they're really working with. It's that attention to detail that only a local lender could bring to that specific transaction.
So local lenders, we're familiar with the market. We're also familiar with the agents. You aren't just a client, you're also a future neighbor. You might be a current neighbor. Also, when there's problems that arise, we have an underwriter where we can go right down the hall, ask questions. We're not waiting for a processor in California or a closer in Florida. We have people that are right down the hall where we can get answers to your problems fast.
I think the biggest piece is being able to reach out to that lender at any given time, evenings, afternoons. If you go to the big banks or the online lenders, 5 o'clock on a Friday, good luck getting anybody to answer you. Whereas we're always trying to make ourselves available. Most people are looking at homes on weekends when they're not working, so we understand that. Also, having local appraisers, I think, is extremely important. If you work with some of the larger mortgage companies in the country, they can get appraisers throughout the entire country, but you might get one from 2 or 3 counties over or even more, and they don't know our local markets. I've had to jump in and save transactions from that. Not to say that our appraisers are doing anything differently as far as the work they're performing. It's just they understand the markets and the neighborhoods, and that's very important when it comes to values, as everybody knows.